Something unusual is happening on dealer lots across the United States right now. Brand new vehicles are sitting, not for days, for weeks, sometimes months, with window stickers that started at full MSRP and have quietly accumulated dealer discount after manufacturer rebate, after financing incentive until the original price feels like a number from a different market entirely. Inventory is building in specific segments. Days of supply, the metric that tracks how long it would take a dealer to sell through current stock at the current pace, is climbing in categories that were stripped bare just 2 years ago. And while certain models continue moving at a healthy pace, others have effectively stalled. The demand simply is not there at the price and in the form the manufacturer and the dealer expected it to be. Today, we are counting down the 7 worst selling cars in the United States right now. And more importantly, we are breaking down exactly why demand has collapsed for each of them. Because when cars stop selling, they do not just create a problem for the manufacturer whose name is on the hood. They reveal structural weaknesses in pricing, financing, consumer confidence, and the broader economic environment that affect everyone who participates in this market. The cars that stop selling first are the ones that tell you where the stress is concentrated before the stress becomes visible everywhere else. Before the countdown begins, the context matters, because these vehicles are not failing in a vacuum. They are failing in a specific market environment that has created conditions where any model carrying excess risk in its value proposition gets punished quickly and visibly. The US auto market is navigating a compression from multiple directions simultaneously. Interest rates at levels not seen in decades have transformed the monthly payment calculation on vehicle financing in ways that have materially reduced what a given income level can afford to purchase. The average monthly car payment in the United States has reached historic highs, and that number is not abstract. It is the number that sits at the center of every purchase decision being made right now. The buyer who could comfortably finance a $35,000 vehicle at 3% interest is doing genuinely different math at 7 or 8%. The vehicle that felt accessible no longer is. The purchase that was stretching slightly before has become a stretch too far. Insurance costs have surged across most vehicle categories, adding another layer to the total ownership cost calculation that buyers are now incorporating more seriously than they did when rates were lower, and attention to monthly costs less acute. Loan delinquencies are rising, signaling that a portion of the buyer population that was qualified under the conditions of previous years is experiencing genuine stress under current conditions. Student loan repayments that were on pause for an extended period have resumed, removing a discretionary cash flow from a significant segment of the market. And the used vehicle pricing that had been inflated through the shortage years is softening, which creates negative equity situations for recent buyers and reduces trade-in values for consumers who need positive equity to finance their next purchase. In this environment, weak models do not underperform gradually. They collapse. The market has become a filter that is removing demand from any vehicle that is mispriced relative to its segment, overexposed to financing sensitivity, competing in a saturated category without sufficient differentiation, or carrying a risk profile that the current buyer is not willing to absorb. The 7 vehicles on this list represent different versions of that failure. Let's go through them, starting at number 7. The compact SUV segment casualty. The compact SUV is the most crowded category in the American automotive market. Every major manufacturer has a product here, And over the past decade, the segment expanded to absorb every buyer who moved away from sedans and every buyer who was not yet stretching to a midsize. The volume was there to justify the competition. What has changed is that the pricing in the segment has crept upward consistently, and the differentiation between products has not kept pace with the price increases. The vehicle at number 7 on this list entered the segment at a competitive price point several years ago and has since been repriced through trim inflation into a bracket where it is now competing directly with vehicles that offer meaningfully more content, more brand prestige, or both. The buyer looking at this vehicle's current sticker price has alternatives that the manufacturer was not competing against when the pricing strategy was set. Days of supply on this model have extended significantly. Dealer incentive support is climbing. Year over year, registration volume is down in a segment where several competitors are holding steady or growing. The vehicle is not bad. It is mispriced for what the current market is willing to pay in a category where the competition has not stood still. Moving to number 6, the overpriced sedan trying to compete in a world that has largely moved on from sedans. Sedan market share in the United States has been declining for years as buyers migrated first to crossovers and then to SUVs. The manufacturers that maintained sedan lineups largely did so by positioning them as value alternatives or as enthusiast products with a clear identity. The model at number 6 occupies neither of those positions clearly. Its pricing has drifted into a range where it competes on paper with entry-level luxury alternatives and with mainstream crossovers that offer more utility at comparable cost. Showroom traffic is declining. Fleet sales are carrying an increasing share of the volume, which is the sign that retail demand has softened to the point where the manufacturer is filling the gap with bulk sales to rental companies and corporate buyers. Fleet volume sustains registration numbers but erodes residual values as those vehicles return to the used market in concentrated quantities. The downward pressure on resale values is already visible in auction data, and that pressure will feed back into consumer hesitation about the new purchase. At number 5, an electric vehicle that arrived before the infrastructure was ready to support the confidence it needed to sell. The EV market in the United States is not uniformly strong. It is strong for specific products in specific segments with specific buyer profiles. For EVs that depend on consumers making a significant behavioral change in how they fuel and maintain their vehicle, the combination of charging infrastructure gaps, range anxiety that is real in the driving patterns of a significant portion of the country, and a rapid depreciation profile that has been made visible by the used EV market pricing is creating sustained hesitation. The model at number 5 launched with pricing that assumed a level of consumer confidence in EVs that the market had not yet developed outside of early adopter demographics. The used values of comparable EVs have fallen substantially from their initial pricing, and that depreciation story is visible to any buyer doing basic research. When the vehicle you are considering purchasing today is already worth significantly less in the used market than comparable new vehicle pricing would imply, the investment calculus is genuinely unfavorable. Manufacturer incentives on this model have increased. Dealer stock is accumulating. The demand that the launch numbers projected has not materialized at scale. Number 4 is the insurance shock victim. This is a category of market failure that does not get enough attention in mainstream automotive coverage, but that is showing up clearly in the sales data for specific models. Insurance premiums are not uniform across the vehicle fleet. They are calculated based on theft rates, repair cost data, replacement part availability, and the profile of drivers who typically purchase specific models. Certain vehicles, particularly those in theft-prone categories and those whose repair costs have increased dramatically due to sensor and camera integration into body panels that used to be inexpensive to replace, have seen insurance premium increases that have added meaningfully to their total monthly ownership cost. The vehicle at number 4 on this list has been hit by exactly this dynamic. Its base price is within a range that a broad buyer population could finance at acceptable payments, but when the insurance premium required to cover it is added to the monthly financing cost, the total number crosses a threshold that is eliminating a significant portion of the potential buyer pool. Young buyers, who are the segment most sensitive to insurance cost as a proportion of income, have been priced out of this vehicle almost entirely. Dealer traffic has declined. Sales are down year over year in a segment where insurance-favorable alternatives are gaining share. Moving to number 3, the luxury model caught in a credit tightening environment. Luxury segment sales are among the most sensitive indicators of credit market conditions because the purchase decision involves the largest dollar amounts and the most significant financing commitments in the mainstream automotive market. When credit tightens, when lenders become more conservative about loan-to-value ratios, and when the income-to-payment qualification standards become more strictly applied, the luxury segment feels the effect faster and more severely than the mainstream market. The model at number 3 is an entry-level luxury vehicle whose sales trajectory has declined sharply as lease rates have increased and as the financing environment has reduced the pool of qualified buyers for vehicles in its price range. Lease residual values, which are the projected future worth of the vehicle that underlies the monthly payment calculation in a lease, have been revised downward for this model, making the lease payment less attractive than it was at launch. Reduced lease attractiveness has shifted potential buyers toward purchase financing, and purchase financing at current rates on a luxury adjacent price point produces a monthly payment that the same buyer finds less compelling than the lease alternative that no longer pencils. This is the specific mechanism by which credit market tightening translates into luxury sales softening. And it is operating on this model right now in ways that are reflected in the inventory levels on dealer lots. At number 2, the incentive-dependent model. This vehicle requires specific attention because its situation is qualitatively different from simple demand softness. This is a model where the manufacturer has responded to declining organic demand by escalating the incentive support required to move inventory. Cash rebates, dealer cash programs, subsidized financing rates funded by the manufacturer's finance arm. The total incentive package attached to this vehicle has grown substantially over the past 12 months, and that growth is visible in the gap between the sticker price and the transaction price at which units are actually selling. Incentive escalation at this level has a specific set of consequences that extend beyond the immediate sales quarter. It trains the buyer market to wait for deals, which delays purchase decisions and reduces urgency further. It compresses the margin available to dealers, which reduces their enthusiasm for investing in the model's representation and training. It signals to the used market that the new vehicle pricing cannot be sustained, which accelerates used value decline and creates negative equity risk for recent purchasers. And it consumes manufacturer profitability that could be invested in the product development that might address the underlying demand problem. When a model reaches heavy incentive dependency, it is frequently the indicator that the underlying value proposition has a structural problem that discounting is temporarily papering over. And that brings us to number 1, the market canary. The vehicle whose sales collapse is not just a product story, but a leading indicator of broader structural stress in the market. This is the model where the year-over-year decline in registration volume is not a rounding error. It is a significant double-digit drop in a segment that was expected to be stable. Dealer lots in multiple regions of the country are carrying stock levels that would have represented months of sales at previous year velocity, and now represent something longer. The manufacturer has responded with incentive programs, with dealer cash, with financing support. The response has not cleared the inventory because the underlying demand problem is not a price sensitivity problem that incentives can solve. It is a confidence problem. The vehicle sat at an intersection of several unfavorable forces simultaneously. Its pricing sits above the range where the mainstream buyer is comfortable committing under current financing conditions. Its category has been affected by the insurance cost increases that have reduced the affordability of the total ownership package for a significant portion of its target buyer. Its residual value forecast has been revised downward by the major forecasting services, which has made the lease payment calculations less favorable and has created hesitation among finance-savvy buyers who understand what a downgraded residual means for their equity position at the end of a loan term. And the broader consumer hesitation about large discretionary purchases under current economic conditions has reduced showrooms traffic across the category. What makes this vehicle the number one signal, rather than just the worst performer in a bad list, is what its failure trajectory reveals about the market around it. A single model failing badly can reflect a product decision, a launch misstep, a competitive miscalculation. 7 models failing simultaneously across different segments and different price points for reasons that all trace back to the same underlying pressures of affordability, financing cost, insurance sensitivity, and consumer confidence is a pattern. And patterns in automotive sales data are the earliest indicators of market corrections before those corrections show up in the broader economic data that generates headlines. When weak sellers accumulate in sufficient numbers, the feedback loop begins. Manufacturers respond to declining demand and rising inventory by cutting production orders. Production cuts reduce the revenue flowing through supply chains. Reduced revenue in supply chains affects employment. Lower employment affects consumer confidence. Reduced consumer confidence reduces auto demand further. Meanwhile, the dealer inventory that accumulated during the correction period, once it is moved through incentive programs and discounting, returns to the used market as nearly new inventory at prices that compress used vehicle values broadly. Compressed used vehicle values reduce trade-in equity for existing owners, trapping them in their current vehicles and further reducing new vehicle demand. The auto loan situation layered underneath all of this adds specific systemic risk. Record average loan balances on vehicles that were financed at inflated prices, combined with extended loan terms that slow equity accumulation, combined with declining used vehicle values, is producing negative equity situations at a rate that has not been seen since the previous major correction. Borrowers who are negative equity cannot trade without covering the gap. Most do not cover it. They extend their current loan or they walk away from the trade. Both outcomes reduce new vehicle demand. For buyers who are in the market right now, this environment creates specific opportunities that the panic narrative obscures. The vehicles on this list, and the many others in their situation that did not make the countdown, are negotiable in ways that vehicles have not been negotiable since before the shortage years. Days of supply above 90 on a specific model is a number worth researching before you walk into a dealer conversation, because it tells you that the dealer has more exposure to that specific inventory than they want, and that the negotiating dynamic has shifted in your favor. Comparing financing terms carefully and considering manufacturer subsidized rates against outside financing can produce meaningful differences in total cost. Evaluating insurance costs for the specific trim and model before committing to the purchase prevents the insurance shock that has been eliminating buyers from certain categories after they have already emotionally committed to the vehicle. The 7 models we covered today are not random failures. They are the visible pressure points in a market that is under real stress from multiple directions simultaneously. They show us where affordability cracks first, where financing sensitivity is highest, where consumer confidence is most fragile. Markets do not shift in dramatic announcements. They shift in exactly the pattern we have been describing. Inventory builds quietly. Days of supply increases quietly. Discounts grow quietly. Incentives escalate quietly. Until one quarter, the data shows a trend that was already fully formed, and the headline catches up to what the lot inventory and the auction prices had been signaling for months. Stay informed. Watch the days of supply numbers on vehicles you are considering. Watch the incentive trajectories. Watch the residual value forecasts. Because in a market that is tightening in real time, awareness of where the pressure is concentrated is not just interesting analysis, it is leverage.